This is part 4 of zone trading, and in this video we're going to be discussing the use of multiple zones. In some instances you'll use more than one zone for an entry. In some instances only one zone for the entry but two zones for the exit. This will of course depend upon the circumstances. Let's take a look at what we mean. Now we have two charts up here for the sake of illustration, an 1100 tick bar and a 6000 tick bar. Both have zones. Now in this particular case we're going to be looking at an entrance using only one zone. So the 1100 tick bar will produce our initial entry. Now we've gone over this before in the previous videos, so we're talking about the same situation here. We're entering fairly early in the day and we're looking for an exit someplace up in here for the initial trade. Now watch how this relates to the lower zone from the standpoint of an exit. Here we're already into the upper band, not the outer band but the upper band, but we're still quite a ways from it here. We're not quite into it here either. The market does pull back. We don't really get into the upper band until right in here as well as in here. So this will permit a little bit more volatility but a longer single trade. Rule keeping in mind that in order for an exit to take place, the high of the bar has to be greater than or equal to this upper band. And the first time you have it is right in here. So whether you entered the trade in here or you entered the trade in here, the exit using a multiple band approach, a dual band in this case, is not until up in here. So if we manage to get in right in around this price level, around 84, roughly speaking, we don't exit up here at 90. We only exit up here closer to 92 or 93. Because why? A multiple band approach doesn't give us an exit until we're right in here. Okay? This is very simple to set up. Now, before we go there, let's take a look at a secondary trade, a short trade in here. Now, let's suppose we entered here. We're using now a double zone entry. Where do we exit? Now we're entering at around 92. Do we exit here? No. First of all, we're beyond the outer band. We don't exit. Could we exit here? Well, let's look at the technical side of this. The low of the bar is at 82.25. The lower band is at 82.22. Okay, so it is not quite below. On the next bar, it's still not quite below. So, point of the matter is, since it isn't below, it could be an exit. Okay, this could be an exit. Now, where does this correspond on the other chart? Right in here. And as you see right in here, you do get below the bar momentarily. So that is a possible exit. But look at the nice trade. You got in at around 92. You're almost down to 82 here. Now, if not there, and of course this would also depend upon the other issues pertaining to your exit, but this is the concept at least. You're either exiting here or you're exiting down in here because you're below the band. All right, so there's a real nice trade here. A dual band approach works very, very well. Let's look at one last trade. Okay, let's supposing you do get in here. You never get into the upper band over here. All right. Now, if you're not getting into the upper band and you're for example, looking up in here, you're going to need a single approach here because you're hitting the bands. You're not even close to hitting the bands there. And the market is beginning to turn. You can see that from other indicators. So, again, single banded approach with a multiple band exit. So if you manage to get in here somewhere, say around 83, where do you exit? You're not exiting that trade until right in here, right in there, based upon group reversals and other factors. Okay, now how do you set this up? In the strategy, the use of the bands, use APZ, ES1, ES2, already provides for a multiple band approach, a dual band. Okay, so all we do is just set this to true, go down to ESDPO1 and ESDPO2, just way down here, here and here. And so what we do is we set the other band to 6,000. So these two bands now are going to be used for determining when to take the trade using the dual band approach. Above and beyond that, you can use your group reversals, of course, for the actual entry. And it's really that simple. Ordinarily, you are not going to want to use a short tick bar, 500, 700. You could, but you're going to get a lot of volatility in that. So you want to use a little larger tick bar interval. 1100, 6000, a nice spread here. And you can look at your charts in order to determine which approach you want to use. But use a nice spread. Dual zone, single zone, either way. One's for an entry. If you're using a single for an entry, you're definitely going to use a dual for an exit. If you're using a dual for an entry, probably you're going to use a dual for an exit as well. It's really that simple. Okay, so it's good to have a workspace that will give you some examples of a variety of zones, so you have something to choose from. Now, one last thing before we go. Keep in mind that the strategy is going to update the tick bar intra-bar. The 6,000 tick bar is updated in your send charts every 100 ticks. So you're not looking for the close of the bar for the exit. You're going to get an update on whether it's in the zone or out of the zone every 100 ticks. So you're not waiting for the close of the bar. And that's going to help in terms of knowing more precisely where to take the trade. So multiple zone approach works really well. Use a nice spread between the zones and you'll do quite well. So that concludes our discussion of multiple zones, zone trading, part 4.